We've talked about different transactions that are tax-free because it's between owners and the entity. But what about tax-free reorganizations? We've got different types of mergers, acquisitions, consolidations, all of these types, which, first off, this may be something in other exams as well, but we're taking this from the tax perspective. So understanding when we have some sort of reorganization change in the entity type, how will that affect taxes? So a tax-free reorganization, this is going to refer to certain types of corporate transactions where neither the corporation nor its shareholders recognize taxable gains or losses. We've got 6 types, type A to type F. Now, is this the most heavily tested topic? No, but would I get familiar with these? For sure. Let's see, starting with type A, this is mergers or consolidations. Now, in this type of reorganization, 2 or more corporations merge into a single entity or consolidate to form a new corporation. Shareholders of the merged corporations receive stock in the surviving or newly formed corporation. So an example here being A and B decide to merge into a single entity AB. And then we'll see, if they change into a completely new one, there's 6 types, and we're going from probably the most common to lesser and lesser common examples, A being probably the most common. Shareholders of Corp A and B exchange their shares for shares in Corp AB. This transaction is tax-free, and the shareholders retain their original basis in the Corp AB shares. Next up, we have type B. This is the acquisition of another corporation's stock for stock. One corporation acquires the stock of another corporation in exchange for its own stock. The acquired corporation then becomes a subsidiary of the acquiring corporation. Example here being Corp A acquires all of Corp B's stock by issuing Corp A stock to Corp B shareholders. The transaction here is tax-free, and Corp B shareholders retain their original basis in the Corp A stock received. We see this is the IRS trying to say, here are examples where we're not going to burden the shareholders or the entity with any taxation. These are just reorganizations of the type of entity as compared to trying to do something, I'm not going to say malicious, but do something to avoid taxation. These are normal situations. Next up, type C, acquisition of another corporation's assets. So this is stock for assets. In this case, one corporation acquires the assets of another corporation in exchange for its own stock. The example here being Corporation A acquires all of the assets of Corp B in exchange for some Corp A stock. Corp B then liquidates and distributes the Corp A stock to its shareholders. The transaction here is tax-free, and Corp B shareholders retain their original basis in the Corp A stock received. Not too bad, nothing crazy. Next, we've got type D. Very clever with the names, but it keeps it easy to remember. A, B, C, D, E, F, G, H. No, just going up to F here. We've got a divisive reorganization. This is where a corporation divides into 2 or more separate operating corporations. So let's say that A decides to split its business into 2 separate corporations, B and C. Corporation A distributes the stock of Corp B and C to its shareholders. In this case, the transaction will be tax-free, and the shareholders retain their original basis in the Corp B and Corp C stock received. Next up, we've got recapitalizations. This is where we're trying to raise money, probably. A corporation changes its capital structure by exchanging existing stock or debt for new stock, debt, or a combination of both. Here we're going to see Corporation A exchanges its existing common stock for a combination of preferred stock and bonds. So we're trying to change how we're raising money. We're going from common stock to now preferred stock and bonds. Debt. The transaction is tax-free, and the shareholders retain their original basis in the new preferred stock and the bonds received. And then lastly here, we got type F. Here, change in identity, form, or place of organization. A corporation undergoes a mere change in its identity, form, or place of organization without altering its underlying assets or liabilities. So example here being Corporation A, which is incorporated in Delaware, decides to change its place of incorporation to Nevada. The transaction is tax-free, and the shareholders retain their original basis in the Corp A stock. So in summary here, in tax-free reorgs, corporations retain their tax attributes, such as net operating loss carryforwards and all of those benefits, and shareholders recognize gain only to the extent, oh, there it is, boot coming back, that you get boot in the transactions. Boot is loot, recognizing that there. Whenever you have boot, you're going to recognize a gain on it. I love it, Delaware. I'll never forget, we're on senior week in college in Delaware and at the beach at a brewery, and the brewmaster asked, hey, does anyone know why the family who owned the brewery decided to start it in Delaware? And of course, I'm there with a bunch of fellow accountant friends and saying, oh, it's because Delaware is very tax-friendly. He's like, no, because they had their roots in Delaware, and this is where their family's from. Just absolute tax accounting nerds we are, aren't we? But we're having a good time. Powering through, getting through this exam, and getting it done. Moving on more with tax. tax-free reorgs? Well, when a tax-free reorganization occurs, it's essential to consider the implications for both the corporation and the shareholders. No matter what section we're in, no matter what kind of question, always consider from both parties, if we're dealing with partners, part of the partnership, and then other partners, how does one transaction affect every party? Because that could be a sim. Is one transaction, how does it affect everyone's basis, their gain, loss, realized, recognized, all that good stuff. Now we get a nice summary here of the tax consequences for each party. Now, generally, this reorganization will be non-taxable for the corporation, and the corporation retains its tax attributes such as unused NOL carryforwards, capital loss carryforwards, and charitable contribution carryovers. These attributes can be used to offset future taxable income or gains, subject to the limitations that we do see for those specific items. And for the shareholder, we saw as well that this is generally non-taxable as well. Shareholders continue to retain their original basis in the stock they hold after the reorg. This basis is important for determining the amount of gain or loss when the shareholder eventually sells or disposes of the stock. And then lastly here, shareholders may recognize gain to the extent that they receive boot. That's a common trend we see through and through. Boot is going to result in gain recognized in the reorg. In such cases, the gain recognized is going to be the lesser of the realized gain and the boot received, which is something we saw in like-kind exchanges as well. We got a great example here. Let's assume that Corporation A acquires all of the assets of Corporation B in a Type C reorg, and Corp B shareholders receive $50,000 in cash, which is boot. Now, the question wouldn't tell you that on the exam, but we are here to identify that, in addition to Corporation A stock. One shareholder, Jane, originally had a basis of $20,000 in her Corp B stock. Well, the fair market value of the Corporation A stock that Jane received is $60,000. The total value of the stock and the boot received is $110,000 because that comes from the $60,000 in stock plus the $50,000 in cash, which is boot. So Jane's realized gain is going to be the difference between $110,000 and $20,000. Makes sense. She had $20,000 of basis and now she's getting value of $110,000. However, Jane will only recognize gain to the extent of the boot received, which here is going to be the $50,000 in cash. The remaining $40,000 of the gain will be deferred and not recognized immediately. So the new basis in Corporation A stock for Jane will be the basis of the stock surrendered, which is $20,000, plus any gain recognized of $50,000, minus any boot received, which is $50,000, plus the fair market value of the stock received, which is $60,000. I know we're taking into account everything, but that's important because we want to make sure that nothing's getting double counted. We want to make sure we're only getting taxed on portions once. That's why we're adding in gain recognized and subtracting any boot received. So here, it's going to be $80,000. In summary, overall, tax-free reorgs, they're designed to allow corporations to restructure or combine their operations without triggering immediate tax consequences. Now, obviously, we always have exceptions to all the rules. Every rule in this exam always has an exception. We've got boot here being the exception. Both the corporation and its shareholders generally do not recognize gains or losses in these transactions, except when boot is received. We want to make sure we understand all these rules. Super important. And let's keep moving along. We got some more examples here. Tax-free reorganizations. Let's assume that Corporation X and Corporation Y decide to combine in a qualifying reorg to form Corporation Z, the only surviving corporation. Now, in this transaction, shareholders of both X and Y will exchange their shares for shares in the newly formed Corporation Z. Shareholders of Corporation X owns a total of 1,000 shares, while shareholders of Corporation Y own a total of 1,500 shares. As part of the reorg, X shareholders receive 0.8 shares of Corporation Z for each share of X that they own, while Y shareholders receive 0.6 shares of Corporation Z for each share of Y that they own. Now, after the reorg, Corporation X shareholders would own 800 shares of Corporation Z. We get that by multiplying 1,000 shares times 0.8. And Y shareholders would own 900. We get that by doing 1,500 times 0.6. The total number of shares outstanding for Corporation Z would be 1,700 shares. That's the 800 from X and the 900 from Y. Now, this is an example of a type reorg in the form of a consolidation because we've got X plus Y equals Z. In this case, both X and Y cease to exist, and their operations and assets are combined under the new entity, which is Corporation Z. Generally, no gain or loss is recognized by the shareholders of X and Y, except when they receive boot, as we've seen, or other consideration, in addition to the stock or securities of Corporation Z. Additionally, no gain or loss is recognized by either Corporation X, Y, or the newly formed Z pursuant to our tax-free reorg here. In this example, the reorg is tax-free to both shareholders and the corporations involved, provided that the transaction meets all the requirements under the tax code that we've seen so far for a Type A reorg. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.